The whisper of quick gains, that seductive siren song, often pulls us from the steady course. It promises effortless ascent, a swift escape from the anxieties of financial uncertainty. Yet, how many ambitious journeys have foundered on the rocks of speculation, lured by the transient glow of market sentiment rather than the enduring light of intrinsic worth? This is the realm where Benjamin Graham's timeless metaphor of Mr. Market truly comes alive. Imagine a peculiar partner, Mr. Market, who daily appears at your door, offering to buy or sell your share of any business you own. Sometimes he arrives in a fit of irrational exuberance, demanding exorbitant prices. Other days, he's steeped in unwarranted pessimism, practically giving his shares away. His moods are volatile, his offers often illogical, and his pronouncements, if heeded without discernment, can lead you down paths of significant regret and profound loss. How do we navigate his shifting whims? How do we distinguish genuine opportunity from fleeting illusion? The answer, surprisingly, rests in a single, potent question. It is a question designed to cut through the market's incessant chatter, to pierce the veil of price volatility, and to anchor your decisions in the enduring reality of what you truly possess. This is the question that, if truly embraced, can save you thousands, perhaps even millions, by shielding you from the emotional hurricanes of speculation. Ask yourself this: if this investment were delisted tomorrow, would I still want to own the underlying business at this price? Pause for a moment with that thought. If the ticker symbol vanished, if the daily price quote ceased to exist, would the intrinsic value of what you hold still resonate? This question forces a profound shift within your spirit, moving you from merely trading ephemeral numbers to deeply understanding the real-world enterprise behind them. It compels you to evaluate the business itself, its competitive moat, its management, its long-term prospects, rather than just its latest momentary valuation. By asking this, you bypass the trap of Mr. Market's moods, sidestepping emotionally driven decisions and fundamentally flawed assets that offer no solace once the market's spotlight fades. It is a filter, a sacred threshold, ensuring that your capital, your trust, is placed not on shifting sands, but on solid ground. There is a silent dread that often lingers beneath the surface of our confident pronouncements, the fear of being trapped, of holding an asset that no one else wants, of witnessing value evaporate with no escape. This deep-seated anxiety is often veiled by the constant hum of market prices, the illusion of easy exits, of liquidity always being a readily available hand. We anchor our perception of worth to that fleeting number on the screen, allowing the market's daily dance to become the sole measure of an investment's health, blinding us to the fundamental truth of the underlying business. This echo chamber of price can lull us into a false sense of security, making us forget that liquidity, like fair weather, is a privilege, not an inherent right. An excessive focus on tradability can subtly obscure our critical assessment, tempting us to acquire what is merely easy to sell, rather than what we should genuinely desire to own for its inherent merit. Benjamin Graham, with his quiet wisdom, offered us a path through this fog. To discern the true viability of a business, independent of market sentiment, we must engage in a deeper inquiry. First, evaluate its competitive advantages, its economic moats, those enduring shields that protect its earnings from rivals. Second, meticulously analyze its balance sheet strength and debt structure, understanding the very sinews of its financial health. And third, project conservative, owner-centric cash flows, imagining what the business could truly generate for you, the owner. Over time, consider this: would you still covet this asset if you were cast upon a desert island, cut off from all markets, and its only value derived from its inherent utility or future earnings, not its tradable price? This desert island metaphor invites us to strip away the noise, to look beyond the fleeting availability of a beer or cellar, and instead to embrace the profound measure of a business's true, enduring worth. It is in this solitary contemplation that the essence of value investing truly reveals itself. We live in a constant barrage of financial narratives, don't we? Each day, a new story emerges, proclaiming the next disruptive innovation, the inevitable trend, the must-own stock. This cacophony of conflicting voices, amplified by mainstream media, can leave us feeling overwhelmed, creating a profound void in our trust. It's a philosophical wound, born from the struggle to discern truth from the relentless churn of market hype. We hear phrases like growth at any cost or future potential whispered like sacred incantations, often masking a glaring absence of tangible value, a lack of economic moat, or sustainable profitability. This seductive rhetoric often leads us, unwittingly, into speculative bubbles, chasing shadows instead of substance. The truth, often counterintuitive, is that market narratives are meticulously crafted to influence perception, not necessarily to reflect reality. True intrinsic value, the bedrock of sustainable wealth, is derived from the quantifiable promise of future free cash flow and the enduring quality of a business's assets, not from speculative stories or the shifting opinions of analysts. This is where wisdom, honed by figures like Warren Buffett building upon Graham's foundations, offers a practical transformation. We turn to the owner's earnings method, a powerful lens through which to dissect reflect a business's true profitability and its sustainable cash generation. This method allows us to see beyond the reported accounting numbers, providing a clearer, data-driven view of a company's worth independent of the market's fleeting enthusiasms. Consider the vivid story of Jesse Livermore, the legendary Great Bear of Wall Street. Even for a master speculator of his caliber, his journey revealed the profound pitfalls of chasing fads or succumbing to conventional wisdom when the underlying value simply wasn't there. His triumphs underscored the critical importance of independent thought, of rigorously data-driven analysis over the intoxicating allure of market sentiment. Livermore's eventual struggles, despite his genius, serve as a stark reminder. Narratives can sway fortunes, but only fundamental value can sustain them. Don't just invest. Understand the why behind every decision. There's a quiet ache in holding onto a belief, isn't there? Especially when the market begins to whisper doubts. We call it conviction, a steadfastness that feels like prudence, yet often it's a subtle camouflage for the cognitive bias of loss aversion. We cling to our initial decisions, ignoring the mounting evidence that whispers a different truth, leading us down a path of significant financial erosion. This silent struggle often stems from a distorted belief that someone else will pay more later, a comforting thought that can subtly replace the rigorous need for fundamental conviction and disciplined risk management. When this happens, investing transforms into a game of chance, a mere gamble on the whims of others. The market, with its indifferent gaze, owes no one a beer, nor does it guarantee a recovery. This is a counterintuitive truth. Anticipating future buyers at higher prices is pure speculation, not investment. It's a common, yet fatal, error that leads many to cling to losing positions far longer than rational thought would dictate. How then do we navigate these treacherous waters of our own psychology? Behavioral finance offers us a clear path, a three-step technique to discern the genuine underlying mechanisms of our investment decisions from the emotional traps that ensnare us. First, before committing a single dollar, predefine your investment thesis with crystal clarity and, crucially, articulate its invalidation points. When does the original reason for owning this business cease to hold true? Second, systematically and actively seek disconfirming evidence, welcoming perspectives that challenge your initial optimism. And third, establish a rational exit strategy before you even enter the position, defining the conditions under which you will sell, whether for profit or to cut losses. That fleeting dopamine rush from a short-term market gain can be a potent, yet treacherous, guide. It can hinder your empowered, data-driven decision-making, leading to the fatal mistake of those who seek actionable, rigorously data-backed financial strategies at the wrong time. It is like trying to write a reliable financial forecast in the sand on a windy beach, immediately gratifying but utterly ephemeral. Challenge the consensus. Find your edge. There is a deep-seated apprehension, isn't there? A quiet unease that whispers of systemic risks and unforeseen liabilities, even when earnings reports sing praises and market optimism glows. This fear often surfaces as a feeling of inadequacy, a sense of being out of step when these hidden issues eventually rupture the tranquil surface of a company's facade. The common distortion, the subtle trap, lies in our tendency to fixate solely on the vibrant growth figures of an income statement, allowing the balance sheet's critical warnings about excessive debt, contingent liabilities, and opaque off-balance sheet arrangements to fade into the background. We convince ourselves that the market will continue to reward leverage until suddenly it doesn't. This is the counterintuitive truth. Seemingly small debt covenants, complex financial instruments, or items tucked away off the balance sheet can, with chilling efficiency, trigger catastrophic value destruction, regardless of how robust short-term profits once appeared. It's like seeing only the tip of an iceberg, unaware of the immense, destructive mass hidden beneath the waves. How do we unmask these silent screams of risk? A practical technique, inspired by the meticulous work of forensic accounting, invites us to dissect the balance sheet with a discerning eye, analyze debt maturity schedules, understand covenant compliance, scrutinize the quality of assets, particularly goodwill impairments, and uncover the true cost of operating leases or pension obligations. These are the threads that, when pulled, can unravel a company's seemingly solid fabric. The story of George Soros and his reflexivity theory offers a profound revelation here. It underscores the critical importance of challenging established financial dogmas, of understanding how market perceptions can, astonishingly, create their own reality. This is particularly potent when systemic risks in heavily leveraged entities are overlooked by mainstream analysis. Soros taught us that markets are not always efficient mirrors of reality. Often, they are active participants shaping that reality. To ignore the silent warnings of the balance sheet is to leave ourselves vulnerable to these self-reinforcing cycles of market perception, cycles that can amplify hidden liabilities into devastating losses. We are uncovering the hidden truths behind wealth accumulation. The sheer volume of financial information can feel like a relentless tide, isn't it? A deluge of data, moves, and expert opinions washes over us daily, often without without clear synthesis, leaving us feeling overwhelmed. This can erode our trust in financial authority, sparking a deep desire for a robust, personal defense system against the market's inherent irrationality. We often fall prey to the common distortion that diversification alone guarantees safety, overlooking the crucial need for individual asset quality and, more importantly, a margin of safety within each holding. This blind spot can lead to a portfolio that is merely diversified mediocrity, rather than a collection of truly resilient businesses. Here's a counterintuitive truth. Market volatility is not a problem to be avoided, but a feature to be understood and, at times, exploited. The one question we've explored: if this investment were delisted tomorrow, would I still want to own the underlying business at this price? Allows you to view market downturns not as sources of panic, but as profound opportunities. It shifts your perspective, transforming fear into the disciplined pursuit of quality assets at a discount. This is the practical transformation, applying the delisted tomorrow question as a rigorous filter for every potential investment. It forces an uncompromising focus on business quality, scrutinizes management integrity, and demands a sincere re-evaluation of your core conviction. This simple yet profound inquiry transforms the chaotic static of market noise into strategic clarity, empowering you with truly independent decision-making. Warren Buffett, with his characteristic plain-spoken wisdom, often likens investing to a baseball game. You don't have to swing at every pitch. The one question becomes your personal strike zone, a sacred boundary that ensures you only swing at pitches you can hit for a home run, or at the very least, a solid base hit. It is this disciplined selectivity, this unwavering commitment to intrinsic value, that safeguards your capital and paves the path to sustainable wealth. Is your diversified portfolio truly diversified, or is it merely scattering your capital without true conviction in each underlying business? So, we return to it, this quiet sentinel, this profound inquiry. If this investment were delisted tomorrow, would I still want to own the underlying business at this price? This is not merely a question, it is a constant guardrail, a whispered promise to yourself against the siren call of speculation and the gnawing fear of significant financial loss. It echoes the very first principle Warren Buffett teaches us. Rule number 1, never lose money. Rule number 2, never forget rule number 1. This is the essence of capital preservation, the bedrock upon which all sustainable wealth is built. True financial mastery, you see, does not bloom from chasing the latest market trend, nor does it thrive on the fleeting narrative spun by eager voices. It blossoms from a deeper soil, from disciplined, independent thought, from a relentless focus on intrinsic value, and from a healthy skepticism towards market sentiment. It demands that we look beyond the headlines, beyond the daily gyrations, and into the enduring heart of a business. This is how you empower yourself to challenge conventional wisdom, to embrace critical thinking, and to build a wealth that is not merely accumulated but truly sustained. It is about making informed, data-driven decisions that prioritize the sturdy quality of a long-term business over the ephemeral fluctuations of the short-term market. Let this powerful question sink deep into your spirit, becoming an internalized practice. Apply it rigorously to every potential investment, allowing it to transform your approach from reactive to proactive, from speculative to strategically sound. Let it be the compass that guides you through the often turbulent waters of the market, leading you to confident navigation and the quiet, enduring growth of your financial life. Are you truly prepared to own the business, or merely to trade its fleeting price?